Well, good morning or good afternoon, depending where you are, and welcome to the latest in the Russo-British Chamber of Commerce webinar series. Today's topic for discussion is titled, What are the scenarios for the economy and business environment because of COVID-19 and weak oil? My name's Alf Torrance. I'm the Executive Director of the RBCC, and I'm delighted to welcome Chris Weaver, CEO and General Director of Macro Advisory, to today's discussion. Thank you as well, of course, to all the RBCC members and friends who have taken time out today to participate. Before we get started, as usual, a few ground rules as to how the webinar will run. We've over 100 people who have signed up for today's event, so it will need, as always, a little bit of management. After I've finished, Chris will make a short presentation lasting about 20 minutes. I'm sure many of you will want to put questions to Chris, so please use the hand up function on the Zoom app to let us know if you'd like to ask anything. However, the best way of getting your question heard is to use the chat function to send us your questions during the course of the webinar. The RBCC team will be monitoring the chat room and will try to pick out some of the more popular themes. Please keep your questions succinct and please introduce yourself and your company if it's not obvious. Again, because of the numbers, we're going to have everyone on mute. So please unmute yourself if you're going to speak. And most importantly, please remember to mute yourself again when you've finished. We will be recording this webinar and we'll post it today or tomorrow. So you'll be able to go back over it. We'll also post Chris's PowerPoint presentation and we'll send it out to you if you would like it as well. I hope that's all clear. Chris Weaver is well known to most of you, as he's a highly respected economist who's been observing the Russo-British relationship for over 22 years. Chris was chief strategist at Sberbank CIB and held similar positions at Uralsib Financial Corporation and Alpha Bank. In 2013, he set up Macro Advisory, and he's the author of a wide variety of published articles about Russia and the wider region. He's widely quoted in the international financial press and appears regularly on BBC, CNN, CNBC, and Bloomberg, as well as many other news sources. Chris, delighted that you're here with us today, and we're very much looking forward to hearing your insights on what is a very complex and challenging economic situation that we find ourselves in. Chris, over to you.
Okay, thank you, Alf, and thank you for this opportunity, and good day to everybody. I guess one thing we could say when we're talking about forecasting the economy, any economy, I guess, right now, is that we should probably put on one of these Gypsy Rose Lee headscarves and a crystal ball, because given the number of variables that are out there, the number of scenarios, all we can do at this stage is create sort of best guesstimates. I think, to be perfectly honest about that, it's far too early for anybody to be able to make any kind of real sensible assessments as to what's going to happen to the economy later this year or for the next couple of years. But let's look at some of those variables. James, slide number 2, please. If we start off, looking at where we're at in Russia right now, you can say the unfortunate thing is we had a very good start to the year. The first quarter numbers are actually very good. There's been a big pickup on retail sales on the back of strong real wage growth. There was also, for the first time in many years, a good pickup in construction. And of course, the agriculture sector also continues to benefit from investment and from the export growth. So across the board, we had this strong start. And of course, as we recall, President Putin at his Federal Assembly address in January, really emphasized the need for faster investment on national projects, and that was all coming through. That's the good news. The bad news is that this current quarter will be pretty dreadful. Anything up to a 20% fall in GDP this current month because of the lockdown in the economy. And very likely we will see contraction of anywhere between 5 and 10% for the quarter. I mean, again, at this stage, it's too early even to be sure of that. It's going to be a dreadful quarter. I think that's the one thing we can be sure of. The key factors clearly is the corona pandemic, the impact on global economies, the impact in Russia, how that's going to play out. At this stage, it's guesswork, of course, but also the oil price and the oil price collapse. So a double whammy for Russia, double negative. But, you know, as I say in the second last point, at least this time around, Russia is in a much better position. So when we see some of the, you know, forecasts being thrown out by IMF, World Bank, and others, you know, they are looking at what happened in previous crisis in 2008, 2009, predictions of GDP falling 5%, 8 to 9%. You know, a lot has changed in Russia since 2008, 9, and also since 2014, 15. So Russia has more resources that it can use to prevent that sort of decline. I should also comment or mention that Alexei Kudrin, former finance minister, head of the audit chamber, he's also been talking pretty gloomily about prospects for the economy and predicting a decline this year, similar to that of 2009, which I think was around 8%. I should remind you that Alexei Kudrin is a professional pessimist. He has forever been talking about doom, and even when he was finance minister, every single year in his budget speech, he would predict the collapse of oil the following year. So it's in his nature. So the fact that he's forecasting doom doesn't necessarily mean we should be all running for the hills. That's what you'd expect from Alexei Kudrin. From other agencies, central bank, economy ministry, etc., they're being kind of more cautious as we should be at this point. So go to slide 3, just to show that good start as the leading indicator. And again, I'm not going to dwell too much on this because unfortunately it's now history, but you can just see that the graph on the far right is the indicator of economic activity in February, and it was close to 3%. But as I say, that didn't last very long. So slide number 4, please, James. And you know, we can look at the first of the issues. The major one, of course, is COVID-19. The graph on the bottom is that kind of relentless increase in the number of reported cases in Russia, which we're all reading about every day. But you know, the main impact is the reaction of government, which of course has been to essentially lock down the major cities, to lock down the economy, and to focus on putting in place contingency measures, support measures for people, for key parts of the economy. But nevertheless, we are expecting, say, a GDP contraction this quarter of between 5 and 10%. We get a better sense of that, I think, as we go through the remainder of this month and of course into May in particular. So next slide, please. The second problem for Russia, of course, is oil. We could spend all day talking about what's going on in the oil markets, but let's just focus on the fact the oil price is down over 60% since the start of the year. It has dipped, Brent has dipped below 30 again today. So the optimism on last week's deal, the OPEC Plus deal with the contribution of G20, did not last very long. And of course, we have written a lot about this and weren't expecting it to last very long, simply because the scale of destruction on demand side is so large. OPEC had optimistically talked about the loss of about 12 million barrels in daily usage this month, but the International Energy Agency is talking about 35 million, and the anecdotal evidence would suggest that the International Energy Agency numbers are more correct. And the second problem for the oil market is that there is no storage, or very little storage for production. So excess, therefore, supply is literally floating around looking for somewhere to be stored or for a buyer. And so hence we could expect the oil price to remain weak in the 20s for most of this month. And then we'll see what OPEC plus Russia and Saudi in particular do, or whether or not there's any kind of more optimistic assessment of the demand side. But for now, of course, a big drop, and that's a huge issue for the Russian budget, which we'll come to. So if we go to the next slide, And we look at what are the critical factors. So sorry, I think formatting is all over the place on this, but or sorry, what the government is doing. We can look at the different phases to expect. And to say, I do apologize, this formatting, I don't know how this is gone into this kind of off center. But phase one, in dealing with a crisis like this is what we've already are into, what we've had, which is essentially the knee-jerk reaction, putting in place the emergency measures, which we're all familiar with. And I guess we could expect some more of those measures in the coming weeks, depending on how the crisis evolves and how damaging it is. Later this quarter, we would expect an interim budget adjustment. So we are aware that all government agencies and government ministries are now currently, looking at their plans for this year. They've all been told to assess their priorities for this year and to come with changes, proposed changes as an interim measure, and would expect that either late May, early June. I've heard that it is possible that we will see a government meeting to review all of this and the dates that had originally been set aside for SPIEF, so that would be the first week of June. And then we would expect to see some budget adjustments to reflect the lower oil price, the extra spending that has been put in place as a response to the crisis, and whatever other adjustments that the government wants to make. And then following that, assuming that there is a calmer phase, I mean, again, kind of COVID-19 is kind of past the peak and we're beginning to see a little bit of daylight and perhaps maybe a calmer oil market, again, all assumptions, then we would more likely expect the government to take a step back and start looking at kind of policy priorities, looking at national projects, looking at what are its priorities for the remainder of this year into next year, and to start adjusting those. And then phase four would be a more comprehensive review of the budget. So it really would be September when I would expect to see major changes in the budget. And again, that's what we hear is that that's on the assumption that we will have a better view of oil price trends. We'll have a better view of what the impact of the COVID crisis is globally and on the Russian economy. In other words, what situation the country will be in and the government can see at that point. So more likely September is when we will get that big adjustment rather than before that. And then after that, I guess for the balance of the year and ongoing, you would expect that such a major crisis will lead to a reassessment of priorities, again, a broader reassessment of priorities. We already know that that's likely to lead to a much greater effort towards localization, which will have an impact for some sectors, certainly on pharma, healthcare, and the critical areas of the economy. Already being talked about increasing the efforts to bring more of that manufacturing and sourcing onshore, therefore more localization. But also on the back of that, and this has been one of the positive things that's already come out very early in this process, in discussions that we're having with people in government and different ministries, there's already a very clear understanding that Russia actually needs to even make a greater effort to improve the business climate, to make Russia a more attractive place for foreign investors. There is a strong sense of realization that, that after this crisis, there are going to be, it's going to be a very difficult global environment. They're going to be very difficult to attract investors and capital, and Russia will have to try harder and have to move faster. And at least that's the discussion right now, rather than anything more negative. It's kind of looking forward looking. Once we get through this, then how do we bring more investors in? How do we persuade them? How do we incentivize them? Which I guess is a good thing. If we go to slide 7, which are the critical factors, just to remind you, is that a COVID-19, how long would it last? What would be the, and also what will be the recovery from this? Because I don't think anybody at this stage has any expectation that there will be a a day when it'll all end and we'll go back to normal. Clearly, that's not realistic. It's going to be much more of a gradual recovery, industries opening up, kind of one by one or in phases. So, therefore, we're now dealing with an evolving and worsening crisis, but I think dealing with the aftermath will be obviously very slow and will have economic consequences and economic impact as well. Again, I'm not going to make any estimate as to whether that's going to be the balance of this year or into next year, but it's certainly not going to be easy or quick, as we know. Oil, I've mentioned. What will be the price? What will be the volume? And clearly, there's going to have to be another round of meetings with OPEC Plus, with G20, to assess the situation, but very likely we are in the critical phase. Well, one thing I will say about oil is that it's very likely that this is the worst of it, in the sense that the lower the oil price goes, then the more, say, US shale oil will be shoved out of the market, and the more high cost production will be shoved out. So in terms of both the deliberate action to cut supply, as well as the economic effects of low oil, which will naturally reduce commercial activities, then supply may look a lot better, i.e. much lower in May and June. And therefore that should have a more positive effect on the oil price, but to be seen. And I forgot slide 8, which really is just, I've already mentioned that on the oil price outlook. Next slide, James, please. And I have to say on the oil price, we have to wait to see how that plays out. But just to remind you of the impact on Russia, again, this is one of those areas where it is not as bad as it used to be. In 2008, well, you look at the 3 crises that we've had since I've been in Russia, 98, 99, it was an oil-driven crisis. 2008, 2009 was also an oil-driven crisis. 2014, 15 was sanctions plus oil. This time round, and I'm not going to use the expression, it's different this time. They say the 4 most expensive words in the English language, but there are differences in that Russia has taken action to reduce the vulnerability and exposure to oil because it had no choice. And it's one of the expressions I always use about Russia when I'm making a presentation, particularly to foreign investors, is that Russia, government or Russia is a country that does the right thing when there's absolutely no other choice. And in 14, 15, that was the situation. The combination of lower oil plus sanctions reduced the options available to the government, and they had no choice but to start dealing with this kind of oil exposure finally. So this year, for example, that the budget would have balanced at $42 per barrel with an exchange rate of 75, all else being equal with spending and tax assumptions, which clearly is not the case. But that's a huge difference compared to 2013, when the budget needed $115. And of course, we ran into that crisis of 14, the recession of 14 and 15 because of that. I will also remind you that in late 2014, it was widely expected that Russia's economy would drop by at least 10% in 2015 and would have an equally bad 2016, and that was not the case. The contraction in 2014 was only a couple of percent, and it was less than 1% in 2016. It was because, again, those who were making those predictions really weren't looking closely at the numbers, weren't looking at how government would react. They did not take into account the fiscal discipline, the policy flexibility that turned out. And I would say to you that is exactly the same again. People who are making these predictions of Russia having a 5 or greater percentage decline are not taking into account the better financial position the country is in, the kind of greater amount of financial ammunition that the government has at its disposal, and the changes that have been made to the economy since 2014 and 15. It is better placed for this crisis than any previous crisis. And also it's worth pointing out that Russia is in a better position than Saudi Arabia. The cost of production doesn't mean anything, and there's been too much about that. who can produce cheaper oil. That really doesn't matter. It's about budget spending. The Saudis need $85, and Crown Prince Mohammed bin Salman needs to keep up social spending, and he's also engaged in an expensive war in Yemen and other commitments that he cannot cut without undermining his own position. So the Saudis are under pressure no matter what they say, and under more pressure than Russia. Remember, they do not have a flexible currency. They're pegged to the dollar, so they don't benefit from a weak currency as Russia does. Also, the US shale producers, a significant portion of those producers are high cost or have high debt or have investors that are not willing to put more money in at this level. So you probably will see, if oil stays at this level, you will see a much greater destruction in US supply, at least over the short to medium term, all of which suggests that this kind of dip that we're seeing in the oil price right now won't last. There will kind of be a natural bounce mechanism up to a certain level. That's not to say it's going to bounce back up to 40 or more. That's not likely, but we should see it bouncing back into the 30s as we see US shale production going down. The urgency will come into it. Next slide, James, please. Because if you look at the effect on oil, obviously on the ruble, we've seen the ruble collapse to over 80. It's come down to 70, actually it's 74 just recently on MySex. So in other words, it's weakened again and this oil is dipped. There is no evidence that the central bank is intervening whatsoever. We saw a $7 billion drop in central bank reserves through March from 570 to 563. I think those are the right numbers. That really is the kind of currency effect. It does not reflect central banks spending $7 billion to try and support the ruble. It is the fact that they have diversified the portfolio of currencies over the years. In other words, they've greatly reduced the US dollar content. Now there's a much better spread of euros, yen, sterling, other currencies, and they're generally all weakened against the dollar over the last month. So that's really what's brought down the value of the reserves in dollar terms. The central bank have always made very clear that they learned that lesson in 2014, early 15. They're not going to throw good money at the currency market when there is a bigger factor driving it. In other words, the oil price or something external. So letting it, hoping it will settle, and then using soft mechanisms such as interventions in the FX market or controlling the flow of export receipts. Maybe that's those mechanisms, how they will try and ease it back. The government still has a preference for a 65 ruble rate against the dollar over the medium term. And that's obviously what's in the current budget. That's what they keep talking about, what they're hoping to get back to. But recognizing, of course, that we're likely to see a much weaker currency for the balance of this year and maybe into next year. But I do not expect to see the central bank using any of its reserves to try and pull it back to 65. They will adjust what they can based on where the oil price is or what the external factors are. Next slide, James. It just in terms of the other big risk, and it is worth pointing this out because there's a lot of discussion about what the risk to employment is. Again, we had this also in 2015, and of course we saw relatively little impact on the unemployment levels. So this table here shows very much kind of worst case scenario, up to over 4 million job losses. That was talked about in 2015 as well. Why it didn't happen in 2015, there's a couple of reasons. One is, as we know, the culture in Russia is not to fire people, but to adjust salaries to try and preserve jobs. So many people have already been asked to take pay cuts in order to keep the wage bill down in order to preserve jobs. And that's what we've seen many times in the past. And secondly, those who tend to lose their jobs in these type of sectors, say retail sector, service sector, a lot of them are migrant workers. So in other words, they don't go on the social welfare register, they go home. So again, it's a safety net. It's a vulnerability long-term for the economy. It's a safety net during times of crisis. So when you talk about potential job losses, that's very much worst case scenario. The reality is it'll be a lot less than that, but still it'll be an issue for the government because, of course, that feeds into public support for the president and for the government, and they will want to minimize that as much as they possibly can. The other point that's a negative normally, but can be a positive at times of crisis, is the relatively low level of small, medium-sized enterprises in the economy. Obviously, this sector is the most vulnerable. But it's too low a percentage of the Russian economy, which is a problem long-term in terms of growth. It's only about 20, maybe 23% of GDP, whereas you would say in a place like China or India or Brazil, it'd be about 70%. But what it means is at times of crisis, it is a small percentage of the economy that's having the biggest crisis. The bigger companies, the state sector, the extractive industries, are a lot more stable. And that's another reason why you don't get the economic collapse that you would normally expect. You will certainly get it in the SME sector, and you'll get it in these sectors that we're highlighting here, in the kind of service sector, in retail, in cafes and restaurants, etc. For sure, absolute destruction. But that's a small sector of the Russian economy. So it's a long-term problem, but right now it prevents the worst case scenarios. So if we go to the next slide, which is just to remind you that kind of having looked at the bad news, here's the good news. The good news is, again, reflecting the fact that Russia is much different or better placed now than in previous crises, and certainly from 14 and 15. And a lot of this is because Russia's had to adjust to sanctions, to external pressures, to low oil in that period. It means that Russia's got a relatively high level of financial reserves. The National Welfare Fund is $160 billion as of the 1st of March. Debt burden is very low. So it means there is no debt repayment pressure, there's no debt service pressure, and there is plenty of scope to borrow more money domestically if the government goes in that direction. So much, when you look at Russia relative to most of the rest of the world, this is a very strong positive. It means that there is money to put into the budget to pay for a lot of supports and to pay perhaps for recovery mechanisms when they come, and also much less vulnerability to this massive drop in oil receipts that we have seen. Also, the last couple of years, we have seen a better mix of exports, because we talk about the weak ruble. Obviously, it's pros and cons. It's negative for households, but household incomes, it's been the biggest factor in the drop in household incomes over the last 5 or 6 years, but clearly very positive for the export sector. So Russia is an export location. And this is one of the themes we're already starting to hear from government officials talking about how the economy can recover from this, is how does Russia attract businesses, not just to manufacture goods and services for the domestic market, but to view Russia as an export location, cheap costs, cheap ruble, good transportation, and with a plan to improve regulations, to ease regulations, but using Russia's resources then as an export base for their product. Again, I think that's a theme we'll certainly hear more of later this year and coming into next year, and obviously the cheap currency does help that. Next slide, James. The budget adjustments, I put this up just to remind you that this is the current budget that's in place, that was approved in March. It does have the extra spending that President Putin talked about in February, the social supports, etc. But you can see it's actually assuming euros $57 for this year. That's about 59 Brent. And clearly that's not going to happen, and it's the exchange rate as well. So there's going to have to be very big changes to the budget. Now I would expect the first changes, say an interim change later this quarter, and then a more extensive 3-year change coming into the autumn. One thing though that this does not take into account is the approximate $16 billion profit that the central bank has made from the sale of Sberbank to the National Welfare Fund, and is expected to transfer that to the budget as a one-off dividend. Just to remind you what that mechanism is, the central bank owned the state's share in spare banks, so 50% plus one share. And that's to all other, excuse me, state companies are owned directly by the finance ministry. The central bank has sold that equity to the finance ministry, to the National Welfare Fund, for approximately $30 billion, last week's valuation. They've made a profit of over $20 billion on that because they carry spare bank at book cost. They will keep a certain amount of it to cover the bailout costs that they've incurred for banks like with Cretia and other banks in recent years. But it's expected that they will transfer about $16 or $17 billion to the finance ministry as a once-off dividend. So that's extra income that had not been taken into account in this budget, which again covers perhaps most of the spending that's announced, has recently been announced. But clearly we're going to see extensive changes to this budget once there is a better feel for the trend in the economy and the trend in the oil price in particular. So next slide shows our provisional forecasts. Now we do, I don't know if you can tighten that up. The bottom line is just dropped off, but if we use scenarios, so this base case is obviously in the middle. You know, when the presentation is available afterwards, it'll be obviously a lot easier to read these. But essentially our base case we're looking at is a 2.5% decline for GDP this year and a 2% recovery next year. Obviously an increase in inflation, the central bank key rate, again, our base rate assumption is that they will leave it as it is. And the governor, Nabulina, has talked about possibly bringing the rate down at the next meeting, which is on Friday a week. But our base case assumption is that they will try not to raise it, obviously with the weaker ruble, but really it'll be difficult for them to cut it. But where you can see retail sales, which had been expected to go up by over 3 to 4% this year, our base case is that they contract the budget's deficit. Sorry, there should be a budget balance of -2%. And that's the lines you can see. Assumes an average oil price of $36 for this year, rising to 48 next year, and the ruble dollar rate ending this year at 74 and ending next year at 68. But if we go to the next slide, James, which is the more pessimistic case, and you can see here, this is more in line with what the IMF and others are talking about, pessimistic case of a 5% contraction this year, a smaller contraction, but still nevertheless carrying into next year. And that's because that assumes an average oil price of $28 for this year, rising to only 33 next year. So very much kind of, I would say, worst case scenarios for Russia. And that would imply a ruble dollar rate of 80 at the end of the year and recovering only to 75 at the end of next year. So clearly that having a significant impact on domestic sectors, but boosting others such as agriculture and some export sectors. And then next slide, James, slide 15, what we're expecting. We're looking at national project priorities. There are some sectors that will almost certainly be delayed. So if we look at the plans for spending on, say, education, demographics, culture, perhaps housing, science, these are areas that can be delayed. The greater priorities will be the spending plans on the healthcare, perhaps on the digital economy, on transport infrastructure, wherever they can get a bigger bang for the buck. So I think a review of national project priorities focusing more on those sectors that are necessary to try and sustain growth, as well as those sectors that can support economic activity and move the economy forward. So I'm definitely expecting to see changes there. But also we're already hearing from Prime Minister and other ministers, you know, this kind of understanding that there needs to be a much greater effort to improve the business climate. So, you know, some kind of more negative regulations, such as that which was proposed to enforce apps onto computer and mobile phone devices has now been delayed and possibly will be reviewed, hopefully will be killed, but also a faster effort or an effort to kind of speed up the regulatory guillotine and other changes that were being proposed and now are likely to be brought forward, specifically to try and improve the investment climate. Localization, I think, absolutely has always been on the table, but I think now will be much more focused on key areas, healthcare, pharma, food processing, basic manufacturing, critical areas of the economy. I think much greater effort at localization, and we're very likely to see a carrot and stick approach appear here. Yes, try to encourage you in, but if you don't come in, then possibly making it more difficult to participate in those sectors as an importer or as an external provider. Clearly, in areas like online services, e-commerce, as we can see in the rest of the world, and that means payment systems, logistics, etc., all getting a big boost from this crisis, and that big boost likely to remain afterwards and to kind of again accelerate as you would expect in other countries, same in Russia. The one negative is there is certainly a risk of extra taxation, depending on what the oil price is or oil tax receipts are expected to be. We've already seen, heard from President Putin a couple of weeks ago, where he looked to balance out some extra payments with extra taxation on dividend transfers and on deposits. There's no question that there will be a review of taxation to see where extra taxes can be earned. And so higher wealth taxes, perhaps we know the first Deputy Prime Minister Belousov has always been in favor of extra taxation across extractive industries. Again, these are the sort of areas I wouldn't expect any extra VAT, or I wouldn't expect any additional corporation taxes as such. I think it will be more in the extractive taxes or say higher wealth consumption taxes, or maybe even higher income taxes. But I think tax review certainly is something we'd expect. And then fairly quickly, just the last couple of slides, next one, James, on politics. To reflect on that, obviously constitutional referendum was postponed. All of the surveys suggest that there is no kind of question now over those amendments. When the referendum is held, all the amendments will be passed comfortably, so there's no really issue there. We're still of the view that Putin has not made his mind up yet with regard to 2024. What he has done with regard to constitutional referendum and the option to stay, I think mainly is to avoid lame duck presidency, which was beginning to emerge. There was already, kind of a lot of infighting and different groups kind of looking to pursue their own aims and not necessarily taking into account Putin position. So now that lame duck presidency is off the table and he's very much in charge because he may stay. The approval rating stays high, but the trust rating, which is much more relevant. I mean, the approval rating means nothing as such because there's only one person to vote for, as it were. But the trust rating does offer a much better view of how people how they think about the president and his management. And that's half what it was 2 years ago and has been falling. So this is kind of one of the key areas where the president administration staff have been focusing on, and certainly is the key reason why they have focused a great deal on promises to rebuild income, real disposable income, household income, and economic kind of well-being in general. It's because it's very much linked to that trust rating. And whatever Putin wants to do in 2024, he really will need kind of strong public support for that, as we saw in 2008. So whatever changes happen in budget, we certainly would expect them to try and avoid reducing kind of promises on income or social spending, and to try and emphasize areas that can rebuild incomes and disposable incomes as fast as possible, perhaps in 2021 or 2022. That's a very key area. So therefore, when you look at the retail sector, you can say absolutely destroyed right now, will be slow to recover, but budget policies and political emphasis might mean that that picks up more strongly than next year, because it needs to. And we can see in different surveys people's frustration and even kind of a rise in willingness to protest. Don't pay too much attention to those surveys. I know they'll get headlines in international media saying, oh, more and more people are willing to protest and expect protests. This is very much correlated with economic activity. We saw exactly the same thing in 1999, in 2009, and 2015. There's always a spike in people kind of expressing frustration and thinking there might be protests, and as soon as the economy picks up, it just goes away again. So again, no reason to assume that there would be any different. Next slide, James. Geopolitics, again, the inward investment, and I think we saw this coming across quite a lot in the last year. There's been a real effort in Russia to kind of keep it calm, as well, to avoid any fresh controversies. And a lot of it is because they just need the inward investment, and that'll be even more so. Russia hoping to avoid additional US sanctions, which may or may not come anyway, depending on what happens with the US election. Clearly off the table for the moment, but the election period is the dangerous period, so they still may come. But Russia hoping to avoid that, and very much focused on trying to improve relations with the European Union before this crisis, and hence we were expecting to see some compromises, some progress with regard to Donbass and eastern Ukraine. Clearly these talks are now delayed, but we can definitely see that as a huge priority for the Kremlin, is looking to kind of make progress there with a view to improving relations with Europe. And again, all very much focused on looking to reduce trade barriers and to bring in more investment. And then finally, the very last slide, James, on 18, I say just to make the summary points, say we had a good start. We're going to take a big hit this quarter. It will be bad. Whatever you think it's going to be, probably double it. But what happens in the second half of the year and coming into next year will depend on COVID and oil. And again, it's far too early to say how they're going to play out, either domestically or globally. We know on the oil price, we can have a pretty good idea that it's going to be worse before it gets better, and the worse it gets, then the more likely it is to get better, simply because of the supply destruction. This time round, Russia is in the best financial position it's ever been coming into any crisis. That does at least give the government a lot more options than it would not otherwise have had. It means we should be able to avoid, the sort of financial crisis that we saw in 2008-9 or even in 2015, and also should again avoid deep recession. Remember, deep recession was predicted in 15 and 16, didn't happen. I don't think it's going to happen this time either. And a lot of it is because the SMEs and sectors that will take the biggest hit are too small. The banks, though, sorry, I should have mentioned that earlier, there's definitely a question mark there over bank stability. You would certainly expect to see more banks failing during this crisis, the level of non-performing loans, the fact that banks are having to restructure loans, delay interest charges, etc. It's going to absolutely wipe out profits, but it'll probably wipe out a few banks as well. And that clearly will have an impact on recovery time afterwards as well. National projects, we're watching to see what happens there. Definitely expecting to see a lot of changes. And I say for foreign companies, it'll be very much a case of those who are willing to localize to a greater extent will get the greater benefits. So I leave it at that. That's kind of a quick run through. As I say, I apologize for the formatting on the slides, but the document will be available afterwards, and we also provide more detailed economic forecasts in remaining slides, and some flesh out some of the scenarios as well, which you will be able to see. So thank you for your attention, and back to you, Alf.
Chris, thanks very much for that really clear and insightful presentation. We've got just exactly 15 minutes for questions. The first question comes from Luke Connor, probably known to you, managing partner at Connor and Company, a legal firm. And his question is, why have the markets rebounded when there seems to be completely disconnected from the real economy and real activity levels? And from a Russian perspective, Chris, say that GDP will be down 20% this quarter. From what Luke sees on the ground, however, most people are doing pretty much nothing. The mentality is more holiday than home office. And is Luke, like Kudrin, being too negative?
Okay, well, markets. Well, first of all, markets, there's always a disconnect between markets and the real world over a short period of time or short to medium period of time. Traders anticipate events, they try to, or investors try to anticipate events rather than looking at what's happening on the ground right now. So you had a 20-25% fall in the RTS index in the first quarter. That reflected kind of the buildup of fear, what was coming. And now, investors are thinking, well, maybe they're reflecting on a little bit more of the optimistic scenarios, which is that COVID-19 will soon peak. And you hear from countries like, say, Spain and in Germany and other countries talking about when they might be able to reopen. And even in France or the UK, where the crisis is still evolving, they're still talking about possibly maybe May, June. So in other words, within the near term. And then for investors, at current valuations, if you believe that, or if you're optimistic, then yes, you start buying right now. So you always get a disconnect. But if there's any fresh bad news, of course, the volatility will be there, and you are taking a risk in buying into that uncertainty. But the fact that investors are starting to look at low valuations and anticipate when this might end and how it might end is not at all surprising. People are already looking into later in the year and what recovery might do to market valuations. So, if you think the oil price is going to go back up in the summer and COVID-19 is going to be greatly dealt with, then yes, you should buy right now, but you are taking a risk. Kind of clarify in terms of the economy, I mean, GDP declined for April because of absolute shutdown. As you say, everybody's on holidays at home, nobody's doing anything. So a GDP decline of 20% for April, it would not be kind of unexpected. For Q2, I'm expecting it'll be more 5 to 10%. So more balanced, because I'm assuming that we will start to see some easing in May and picking up in June. And also remember, extractive industries and big parts of the economy, state enterprises, etc., are all continuing to kind of generate activity for GDP. So 5 to 10% decline for the second quarter is not unreasonable. What you're looking at in terms of the street and outside your window, with shops closed and bars and restaurants closed, that is in the smaller segment of the population or of the economy, and that sector is absolutely be destroyed. And it's your guess is as good as mine as to which shops, which restaurants, which bars are going to be even able to open when they're allowed to. A lot of them simply won't. And do bear in mind that historically, when you look at economic recessions and downturns in markets, the most dangerous time is usually in the early part of recovery. That's when you get more company failures and more bankruptcies, because companies have to re-gear and there's more pressure, etc. So I would say that that segment of the population, of the economy, the leisure sector, retail, shops of all sorts will struggle very, very badly. And if you were looking at that only as the economy, you could absolutely 20 to 30% down this year, it would not be unreasonable. But overall, in the Russian context, looking at the makeup of GDP, you're still reasonable to look at 5 to 10%. For the quarter, and as I say, we have 2.5% decline for the year, but that assumes a pickup in the oil price and an easing of COVID in the summer. The worst case scenario is 5%, which is that everything lasts for much longer into the autumn.
Thanks, Chris. Luke, would you like to go back to Chris about that, or are you happy with the answer? Okay, nothing.
I'm fine, thank you.
Okay, thanks, Luke. Great. Okay, our next question is from Daniel Brooks. He's investment advisor at Food Empire Holdings and deals with the coffee element. And his question is, one second, just here. Yeah, does the Russian government have any specific and effective programs to boost investments in the private sector, such as reducing bureaucracy and corruption, supporting the financial markets in this country, and other measures?
Well, I suppose the short answer is no. But let me elaborate on that, and in the sense that you know, there's always been discussion about trying to, you know, deal with kind of bureaucracy, corruption, you know, that affecting entrepreneurs and small businesses. And the reality is that these really are not yet priorities. The major priorities are still kind of, you know, the big ticket items, the national projects, the big companies, the big employers. They remain very much the kind of government priorities because they're more comfortable with supporting these companies and helping these companies to grow. And hence we've got this, you know, very significant mismatch in the structure of the economy relative to kind of more normal structures. In other words, 65% or so of the economy is accounted for by government companies or the government itself, and only about 20 to 23% by SMEs. So it's not really a priority. Of course, there's always lots of discussion, recognizing that there needs to be more assistance given to SMEs and to entrepreneurs and to help investment in these sectors. But really, it's what say lip service at this stage. We have not seen any effective measures specifically directed towards this part of the economy. And what that does mean is that, yes, while the recovery you know, will be largely driven by the big companies and the state sectors and by the government itself, that recovery necessarily will be limited, will be capped. Because in order to go, you know, in terms of your full potential and to expand the economy, you would need SMEs and entrepreneurs and others to be very active, as is the case in other major economies. And that's not the case in Russia. So we can talk about, therefore, the hit on the economy has been relatively limited, maybe 2.5%, at worst case 5%. We can talk about recovery of 1 to 2% in the next couple of years. But that's about it. You're not talking about 5 or 6%, which is what an economy such as Russia needs, because you don't have that kind of key driver, the SME sector, the entrepreneurs, small businesses. And I think their crisis like this tends to put them further down the list of priorities, as we've seen previously. So I'd say a setback for expectations that this will become a sector of priority for the government. I think it will be very much later or down the list of priorities.
Thanks, Chris. We'll move straight on to the next question. Daniel, unless you have a very quick comment on that, or are you happy?
I'm happy. Thank you for the presentation.
Great.
Thank you, Dave.
Okay, our next question is from Richard Connolly. Last time I spoke to him, he was at Birmingham University. I'm not sure if he still is. But his question is, how seriously do you take Russia's apparent commitment to cut oil production by 2.5 million barrels per day? Even if we take NGLs into account, it seems optimistic given climatic factors.
Yes, you're right. It is optimistic. And there's, you know, first of all, I really don't see that happening, you know, very quickly. As you pointed out, climatic and geological factors, and I'm certainly not a geologist, I'm not going to go into it. What I do know is it does take longer for Russia to turn down production, and it takes longer for it to, you know, turn it back up later. And certainly, you know, a much longer process than is the case, for example, in Saudi Arabia, which appears to be a much easier process in terms of turning taps on and off, which is why you always hear the arguments from the Russian oil majors that, you know, they don't really want to participate in these cuts because it takes a long time, you know, for them to actually manage it. And then when everything is fine, it takes them a much longer to recover. So basically, I would expect that as we saw in 2016, 2017, Russia is able to contribute maybe up to 500,000 barrels of cuts But beyond that, it's going to be very slow. So again, it'll be a factor coming to the summer when you start to see the numbers and you see that Russia didn't cut its commitment on the 1st of May because it can't. And it's been much slower. And we'll hear exactly the same dialogue. Russia's Energy Minister Novak will be at the OPEC Plus meeting saying, no, you know, be patient. We're doing it. We're moving in the right direction. And everybody will be, Saudis will be frustrated. So it'll be a factor in the discussion. I think in reality, what everybody's hoping for is that this period of low oil will massively take down US production, and that's what will save the oil price from collapsing, say, to 20 or even lower. I might bring it back up into the mid-30s. And I think this year, my opinion is that I think that the OPEC Plus are hoping if they can get the oil price back into the mid-30s by the end of this quarter, and then perhaps up towards 40 in the autumn, they'll be satisfied at that. But for that to happen, not only do you want some recovery or some reduction in the demand destruction that we're now seeing, but also perhaps bigger cuts in US shale and longer for those cuts to be returned later, rather than an expectation, say, that Russia is going to deliver on its promise. My guess is probably deliver half of it at best.
Thanks very much, Chris. Richard, would you like to come back on any of that quickly? Okay, we'll take that as a no. Unfortunately, we've probably only got time for one more question. This is quite an interesting one. This is from Dmitry Alexeyev, and he writes, US considers Russia as a strategic threat and fights it by cutting it off from trade income, foreign investment, and high tech. And US has a good chance in succeeding in this. Is it feasible for RF businesses to continue integrating into international business despite the restrictions?
Yes, of course, there is no choice. Russia, like any economy, has two choices. Either they choose to be part of the global economy as best they can, and then hope to attract investment and to modernize the economy and to continue growth, or you choose to close your borders and become insulated. And in that case, then you have a much lower level of economic and social development. And you might have safe borders, but you've got a much lower level of lifestyle and a much less developed economy if you do that. So really, Russia, and I'm happy to see that the government also takes the view that despite sanctions and restrictions, they have to try to bring more foreign investment into Russia. So hence the promise for the regulatory guillotine this year. And I expect that there will be a greater effort to try and improve the business climate. Also to attract money, we also see now efforts to try and re-engage with the European Union and with other countries, again, to diversify investment and trade. And to kind of work around the sanctions as best they can, and to try and bring in investment and to create partnerships that can compensate for, this restriction on access to technology, etc. So, and I think the reason for that is the one thing that we all forget is that people in Russia are changing. The population is changing. There are people who are now in their who are in their 30s and 40s who've got no memory of Soviet Union or no memory of what a closed society was like. It's very open. People are active users of the internet. They can watch international news. They see how people live, and you can see that in the surveys. The public frustrations are about healthcare, about poor housing. Concerns are about income security, about future job security, the economic well-being generally. These are all changes and changes that the government cannot fight or cannot ignore. They really have to deliver on what people want, which is kind of a developing lifestyle, a normal lifestyle. So yes, you could put the Russia kind of political overlay on that, the Russian view of the world, but in reality, people just want to have, income security and a better lifestyle and better access to healthcare and education, and that's changed, and that's an enormous change in Russia in the last 20 years, and it's now an established fact. And if this government does not deliver on that, then you will see more kind of social changes, more political instability, and more demands for kind of policy and political changes. And everything, the discussions we have with people in the administration, etc., even before this crisis, all reflected on that. There is a real concern that if this government does not deliver on people's expectations, then they may be dealing with a different social political dynamic in 2024 or certainly sometime in this decade. And that's why President Putin has really talked a great deal about social spending, about the need to improve lifestyles and real disposable incomes and household incomes, etc. Because, to quote Bill Clinton back in his election day, it's about the economy, or it's the economy stupid, I think was his slogan, but it really is about the economy and delivering on people's expectations. And you cannot close the border, and you cannot therefore isolate yourself. And the government is doing the right thing, which is trying to compensate, to work around these restrictions, but remaining as open as it possibly can.
Chris, thank you very much for that. I'd just like to apologise to everyone as we're not able to answer all your questions. But Chris, if you're happy, could we finish off with one more, if
Sure.
that's okay?
Yes.
Yeah, okay, the final question is from Yulia Maximovskaya from LBS. And she asks, how does Russia's response to COVID compare to other countries? And from the managing pandemic standpoint, from the managing pandemic standpoint, and also economic measures undertaken. Thank you.
Well, I mean, again, it's a difficult one to answer. I guess it's one of those questions that'll be answered more accurately with hindsight than in the midst of it. Russia was slow, I guess, to react, but then picked up the pace very strongly. There's always suspicions that the numbers in Russia look low, albeit they are now picking up actually quite aggressively this week. But then you look at the fact that the borders were closed so quickly, and Russia's borders can be closed relatively quickly, and then the lockdown was put in place and has been extended. I suppose you could say there's never an optimum way to react. Russia is reacting probably as best it can. There's question marks, of course, over the available medical facilities, over testing, as there are in other countries, and clearly there isn't enough testing, and there probably isn't enough facilities. It's difficult to see, what else can be done. The country is now in absolute lockdown. In terms of economic response, I guess so far it's been very much about containment and, ensuring that people have enough basic income to, survive through this period. The real question will be when we see the first budget adjustments, which is, say, I expect sometime in late May, early June, is to what will be those adjustments, what will that mean in terms of the economy and commitment, and how will the government start to use its resources at that point to try and revive the economy. But right now, we can always be critical about what any government does. It's never enough. It seems to be containing the situation for now, but next week it could change. But I think, as I say, it's one of those questions that only hindsight and historical analysis will give us an accurate answer on.
Chris, thank you very much, and thank you for your time in what's been a really interesting conversation. Thank you to all our RBCC members and friends who have joined us for the webinar series. As I said at the beginning, you can find a recording of this webinar, which we will post today or tomorrow if you'd like to go back over any of the material. We'll also post the PowerPoint presentation, but if you would like it sent to you directly, please get in contact with James Lee at the RBCC, and he'll send those to you, as I said, straight to your email address. Once again, a huge thank you. Please keep an eye on the website. We have an exciting series of webinars next week and the week after, and it's great to have such a large audience participating. Chris, thank you very much.
Thank you, Alf.
Next time.
Take care.
Bye. Thanks.